There are a few terms, sometimes, we may get confused between. Returns, yield, and interest could be such terms in finance. While we have already had a look at returns and interest, we now bring you an explainer on what is yield.
Ever wonder why savvy investors are so obsessed with yield? What makes it such an important factor in their investment decisions? It's not just about the money they put in, but the fruitfulness of their investments. Yield is a dynamic player in the field of finance, influencing returns and shaping strategies. Whether it's dividends from stocks, interest from bonds, or profits from real estate, yield is the key to understanding the true potential of your investments. So buckle up as we dive into the world of yield, the fruitfulness of your investments. So what exactly is yield? It's not as complicated as it might first seem. Yield is essentially a measure of the return on your investment. There are various types of yield, each applicable to different kinds of investments. Let's take a look at a few examples. Consider dividend yield. It's calculated by dividing the annual dividend payment of a company by its current share price. This gives you a percentage that tells you how much cash flow you're getting for each dollar invested in a company's equity. Now let's talk about bond yield. It's the return an investor realizes on a bond. The most common is the yield to maturity, which is the total return anticipated on a bond if it is held until it matures. And finally, yield on real estate. This is calculated by dividing the annual rental income of a property by its market value. Now that you have a basic understanding of what yield is and how it's calculated, let's move on to how it differs from another commonly heard term, interest rate. Often people confuse yield with interest rate, but are they really the same thing? Let's unravel the mystery. Think of yield as a measure of total returns you get from an investment. This could be from dividends, interest payments, or even capital gains. It's dynamic, changing with market conditions and the performance of your investment. On the other hand, the interest rate is more like a fixed percentage you earn or owe. It's the cost of borrowing money or the return you get from fixed income investments like bonds. The interest rate remains constant for a set period, regardless of market fluctuations. So, while yield and interest rate are related, they paint different pictures. Yield is like a panoramic view, encompassing all possible returns from an investment. In contrast, the interest rate is a close-up shot, focusing specifically on the returns from borrowed funds. In essence, yield is a more comprehensive measure of return than the interest rate. So, why is yield so important in your investments? Well, we've learned that yield reflects the total return on your investments, whether it's dividends, bonds, or real estate. Unlike interest rates, which are more stable, yield is dynamic and can change based on market conditions. It's a crucial factor in making investment decisions, as it directly impacts your returns. Remember, understanding yield can help you make more informed investment decisions. It's not just about the amount you invest, but also about how fruitful that investment can be. So, keep an eye on the yield.
Hope you got the essence of what does yield mean. Please let us know if you have questions or simply any more such terms you easily get confused with something else. We are here to handhold you to gain some more financial wisdom. Stay tuned. Cheers.